Michelle, thanks for coming on the show.
Thanks, Dan, for having me. It's a pleasure to be with you.
Yeah. So are you in New Orleans, Louisiana at the moment? My favorite city in the Union.
I am in New Orleans. I'm not from here, but I am in New Orleans.
Nice. If you don't mind me asking, how'd you end up down there? Because it seems like a place that most people, in my experience, are from there, and it's people go there on vacation. But I'd love to hear how you ended up there.
It's kind of a long story.
Yeah.
But I'm from Long Beach, California. Grew up in Texas. Met my husband in Dallas when he was in medical school, and he's from Louisiana, so he moved me here.
Yeah, not the worst place to be. Anyway, acquisitions and that sort of thing. And I think that I love this topic. We've had a lot of acquisition focused specialists on our show because it's just even if you never sell, it's such a valuable thing to be able to think as if you were an acquirer and kind of take a step back. And running my own business is something I think about a lot. So there's so many places to go with it. I guess I know, first I just love to understand, like, what are you seeing right now? Like, what's keeping you busy in the acquisition space these days?
Well, what's keeping me busy is my book launch is coming up, but we have, there's a lot of buyers right now. There's a lot of activity in mergers and acquisitions, and most business owners, people don't really realize that because they think, oh my gosh, the pandemic. Well, we have more activity now than ever before. There are so many buyers right now, and there's more buyers for good businesses than there are good businesses to buy.
Yeah, that's what we're seeing as well, and especially in like so many digital spaces, especially Amazon, e-commerce, Amazon agencies. It's really a seller's market. It seems like to an extreme degree. So I'd love to dig into the book a little bit. So we're talking about Exit Rich, to plug that out June 22nd, if I have that right. So I guess the first thing is what can a business owner expect to learn? Like what should they start to prepare for, even if they're intimidated and they're thinking, I'm nowhere near selling?
Well, there's so much to prepare for. The first thing is what Steve Forbes says is true. Steve Forbes says 80% of businesses will not sell. 8 out of 10 businesses will not sell. And Steve Forbes endorsed my book, Exit Rich, by saying it's a gold mine for entrepreneurs. But why is that? Well, the number one reason why businesses are not selling is because business owners never think about selling. They never plan for the sale of their business. They never build a business that someone actually wants to buy. They don't think about selling until a catastrophic event has occurred, whether that's internal or external. Internal being health issues, partners disputes, divorce, death. External is this pandemic. The worst time to sell your business is during a crisis. The worst time to sell is in the middle of a catastrophic event occurring, because you might be able to sell it, but you're never going to be able to maximize value. The best time to sell your business is when it's in its prime. So there's so many places, things for business owners to think about. First and foremost, I tell business owners, it's kind of like the Stephen Covey approach, start with the end in mind. So I always tell my business owners, start with the GPS exit model. It's kind of simple. You want me to take you through it?
Please, yeah.
So when you want to drive somewhere, Dan, what do? You pull out your phone, you go to Google Maps, you plug in your
GPS destination, basically.
Your destination. Do you think business owners have a destination?
I think they do, but oftentimes, no.
They don't. I don't care what they think. They answer, they don't. Most business owners, I've been doing this for 20 years. I've sold over 1,000 businesses. Most business owners do not have a destination. So they're driving around in circles, driving up and down the financial hills to end up exiting poor, to end up broke. And business owners don't plan to fail, they fail to plan. So the first thing a business owner needs to do is follow the GPS exit model that I talk about in Exit Rich. Determine your destination, determine your end game, determine your desired sales price. Pick a number. And you can tweak the number along the way, because business owners always get hung up on a number. I'm like, just pick a number. So let's say you want to sell for $20 million. That's your number. Now, what does the GPS exit model need to know? It needs to know where. Go ahead.
I was going to say how to get there, I guess.
Well, it needs to know where you're starting from, right? GPS always needs to know where you're starting from. What is your current location? What is your current evaluation? And it's shocking, Dan, that most business owners have never had a business evaluated. They don't get their business evaluated until somebody says, oh, I'm thinking about buying your business. And then they might get a business evaluation. We go to the doctor once a year to make sure our heart's still ticking and we're still kicking. We drive our car to the mechanic to make sure we get an annual tune-up. But we never take our most valuable asset, which is our business, and get an annual valuation checkup. That's financial suicide. There are events to increase valuation. There are events to decrease valuation. This pandemic is a perfect example of that. So you need to know every year what your business is worth.
Right. And let's dig into that a little bit. So, using the metaphor of, a car or the human body, like what's the diet, exercise, diabetes, the common ailment for the human body? What would you say that is for businesses? What are the red flags that when you're doing these evaluations just come up like, I can't believe it's this problem again?
Most business owners don't know their numbers. They're completely clueless. They have no idea what they're making. They think that they're making money and they're this close to going out of business. They run personal expenses through their business and they don't keep track of them. So they have no idea what they're really making in their business. They don't know what their EBITDA is. They don't know what their adjusted EBITDA. And they just don't know their numbers. That's number one. That's the biggest.
Yeah. And just to understand, are you seeing that play out even with organizations that have been around for years, even with companies that, you would think would have that? Does that still continue to surprise you how much people don't know their numbers?
Nothing ever surprises me anymore. I mean, we're selling a company between 60 to $70 million. They don't know their numbers, They're like, Michelle, we're making $10 million a year. And I'm like, no, you're not. You're making like $2 to $3 million a year when I first started working with them. Well, last year, they generated $17 million in EBITDA. But before that, they were nowhere close to $10 million a year in EBITDA.
Yeah. And I don't want to get stuck too much just on the numbers point, but I'm just to dig into that a little bit more. Like, how is that playing out? Because I have to imagine that they have bookkeepers, they have accountants, they have all that. Like, what's obfuscating their understanding of their numbers tangibly?
I think, there's lots of things. One of the biggest issues with business owners is they've been living out of their business for so long. So they're running personal expenses, meals, travel, entertainment, tuition, employees, family members that are not actually working in the business, and all kinds of other personal expenses. And they don't categorize it. They don't keep an Excel spreadsheet every year. So they don't remember, or they're thinking, oh, I can add all this back, but it's on the balance sheet as an asset. So you can't add it back. So a perfect example of the company thought they were making $10 million in EBITDA a year. They were trying to add back loans and now we can add back the interest, but not the principal. They were trying to add back equipment that they paid for. They were trying to add back all kinds of different loans, real estate, etc. It's on the balance sheet. You can't add it back. It's not an expense item.
Right.
So they were confused about the numbers. They were confused about how accounting works.
Yeah. And it's always kind of like reassuring to me, even on a large scale, how many companies don't quite understand it. So it makes me feel better about when I don't understand these things as a smaller business owner. So that's a really good point. And to take things, a little bit more positive, I'd love to just understand, like, I think a lot of the times people have limiting beliefs about what they might be able to get, about the valuation. And then when you hear about big multiples, in my understanding is it's often like a strategic purchase, So can you dig into that a little bit? Like, where is there sometimes diamonds hidden in the rough? Like, where are people often missing out on those opportunities for like a bigger exit than they might have first imagined?
I'm sorry. Explain the question again.
Yeah, I guess I'm just trying to figure out, like, where are you seeing opportunities for businesses to take bigger exits than they might have first imagined? Like, where is there more opportunity than people are often thinking?
You mean for business owners to sell?
Correct.
All right. So why don't we do this? Why don't we finish the GPS exit model so your listeners can follow along?
Okay.
And then we can get in those big opportunities so we're not jumping all over the place.
Sure.
Okay. So number one, your end game. Let's say you want to sell for $20 million. Number two, you must figure out what your business is worth every year, an annual business valuation checkup. Let's say it's worth $5 million, right?
Mm-hmm.
Then what's the next thing you need to know is time frame. Let's say you want to do it in 10 years. You're worth $5 million, you want to sell for $20 million, you want to do it in 10 years. What's the most other important thing you must know? You got to know who your buyers are. Now, notice I said buyers, not buyer. Clients come to me all the time and say, Michelle, I have a buyer. Just represent me with this one buyer. I'm like, nope, won't do it. Won't do it because here's the reason why. This one buyer probably will not close on the sale of your business because most buyers fall apart during due diligence. Most sellers don't know how to prepare for due diligence. So therefore the deal falls apart. So we never want to put all of our eggs in one buyer's basket. Plus, how can you ever maximize value if you have one buyer, if you have no competition? So here's the 5 types of buyers, because you want to know, how do business owners get big exits? Well, first you got to understand who the buyers are and what they're willing to pay for, right? So first-time buyers, 90% of buyers are first-time buyers. They buy small businesses. Second is turnaround specialists. They buy distressed assets. They don't buy multi-million-dollar companies. So you got the private equity groups. Private equity groups buy based on platforms and add-ons. They won't even consider a platform for less than $3 million in EBITDA. Add-ons, they'll consider add-ons for less than $1 million in EBITDA. Then you got strategics and competitors. Now, Dan, strategics and competitors pay the highest multiple because they're buying synergies. They're taking advantage of economies of scale. And they're looking at their infrastructure of what overhead they can decrease so they can increase EBITDA from day one of closing. And then the last type of buyers are sophisticated entrepreneurs. Those sophisticated entrepreneurs are industry agnostic. They chase EBITDA. They chase cash flow. They don't always pay the highest multiple because they're not a strategic. They're not a competitor. Make sense? And so then you need to reverse engineer your plan and figure out, well, where do my numbers have to be? Where's my gross revenues? Where's my COGS? Where's my EBITDA need to be if I want to sell for $20 million? You got to have an EBITDA around $4 million, between $3 to $4 million, depending upon those synergies. Then you need to build your business to meet those buyers, those 3 types of buyer specific criteria. Kind of like when someone starts a business, what do? They say, I'm going to make this widget. Here's my ideal client for this widget. I'm going to build to meet their specific buying criteria, right? You do the same thing with your business. Now, how do they get big exits? You want me to answer that?
Please.
So I call it operating in all the 6 Ps. You're never going to get a big exit if the business is 1,000% dependent upon you. Most business owners have created a glorified job in which they go to work at every day versus a business that works for them. Even this business that we're selling for $70 million, the business will never operate without the owner. So we're not selling 100%, we're selling 80%. So you got to look at your business and you got to ask yourself, people is the number 1 P in what I call the 6 Ps. This is the infrastructure of your company. If your company doesn't run on all 6 cylinders, if it doesn't run on all 6 Ps, you're not going to maximize value. So number 1 is people. And many business owners, the business is tied, especially service businesses, but even non-service businesses, the business is tied to the owner. So you have to have the right people in the right seats. And you got to make sure you ask the who question. Who handles marketing, legal, customer service, manufacturing, logistics, environmental? The who should never have you next to it, because a business has to operate without you. So to get maximized value, you got to make sure that the business can run without you.
Makes sense. Yeah. I don't want to cut off the GPS any more than I've already have or any of the part of the system.
We're done with the GPS exit model, so you can ask me whatever you want.
Yeah, there's so many places to go with that, and I love that, and I think I've gotten a lot out of those 5 buyer types, because there's a couple that I've heard of before: strategics, the distressed asset crowd. Just to clarify, you mentioned the add-on. Can you say that one more time? What the add-on group?
Yeah, so let me explain PEG. So PEGs buy 2 ways. They buy based on platforms. So let's say they want to get into food manufacturing and they don't have a food manufacturing business. That's called a platform. They won't invest in a platform for less than $3 million in EBITDA. Some say $5 million in EBITDA. And PEGs have their specific range and they won't go below that. But let's say they're already in food manufacturing and there's a food seasoning business that comes up for sale. They'll consider that food seasoning company, even if it's less than $1 million in EBITDA, because it's an add-on. The add-on support the platform. Right. The platform has to throw off enough EBITDA to support their growth plans.
Got it. So it's like expanding into a new industry might be an example of that, and that sort of thing. Yeah,
you can call it, but I'm using PEG language.
Oh, sure.
So
Makes
PEG
sense.
language is platforms add-ons. Yeah.
Yeah, makes sense. And this is great. So the 6 P's, the first one is people.
Yeah.
And I don't know if you want to get through the others. If you'd like to do that first, please. But I guess one question that I have is, what do you see?
It's your show. You ask whatever you want.
No, I am curious to know. But one question I have before I forget it, which I will, is what do you see people wasting time on? Are there any things that you see like people spinning their wheels on, like, oh, if I want to sell the business, I need to do X, and then you're just like, actually, you don't need to worry about that crap.
Well, I mean, the biggest thing I see, and this is not just for selling your business, this is just in general. I see people wasting time on working in their business. People got to get out of working in their business. You got to stop. You got to work on your business. Get out of the mundane task. Stop doing the task. Focus on your strengths, hire your weaknesses, work on your business. Get out of working in your business. It's not going to be sellable if you're working in it.
Yeah.
And then other things that they do. I've had business owners kind of prep their employees and talk to their employees. That's a big no-no. You don't want to do that. People don't like change, especially employees. They get concerned. So you really don't need to prep your employees. Your employees don't need to know until the sale has closed. Unless it's key employees like a CFO. A CFO is very instrumental in the transaction. And it's always good when we have a CFO in place, or even perhaps a COO, but mostly a CFO.
Yeah. That's interesting. And I'm guessing that the situations can sometimes get sticky between strategic people that need to stay along for the acquisition and people that may or may not be. So I apologize if there isn't a perfect answer for this, but do you have a sense of what works well? Like, how do you manage those expectations with the strategic people and making sure that word's not getting out to the other people? And how do you balance that kind of stickiness, I guess?
You mean with a strategic buyer to make sure the word's not getting out to the employees?
Yeah, or rather to the employees that may or may not be around for the acquisition versus the ones that definitely need to come along to what's the
so happens. Usually, not always, but usually the buyers don't determine who's coming along for the acquisition beforehand, unless it's a situation where, like, let's say we're selling a manufacturing business and they have a distribution center. And a buyer is another manufacturing company that has distribution all over the United States. The first thing they're going to cut is that distribution center. Let's say it costs $5 million. They're going to cut that $5 million. They're going to increase EBITDA overnight. And so at that point, we would have to have conversations with those employees, but they probably would not have those conversations until the deal is closed. And then they would have to have conversations with the owner about severance packages and everything else. Or they might look at their current operation and see if there's any place for those people to fit in their current operation.
Yeah.
But they're not going to have a lot of those conversations until the deal is closed. Every now and then, depending upon the owner, depending upon the comfort level of the deal actually closing, they'll enter into those conversations and negotiations a little bit earlier on before closing. But most of the time, those conversations are after closing.
Right. And the reason that I'm curious about setting that stage and kind of communicating the right way is that in the agency business, kind of for our listeners, it's just people all the way down. Like it's turtle all the way down is people all the way down. So setting that up the right way is so big. So with that, I'd love to hear, a few more of those P's. Let's get to the second P.
Okay. So the first P was people. You don't build a business, you build people, and people build a business. And I will tell you, the number one reason a business is not sellable is because of the people. There's lack of people. There's lack of management team, and it's the owner. And so many business owners, all the data's in their head. Something happens to that owner, the business is gone. So people is the number one reason businesses don't sell. It's the number one reason the business owners can't maximize the value. The second P is product, and the product is your industry or service. You have to ask yourself, is your industry or product on the way up or on the way out?
Right.
Do you have an Amazon and you're in your prime, or do you have a Blockbuster and you're about to go bust? And I don't know if you know this, but when I wrote my very first book in in 2013 called Sell Your Business for More Than It's Worth. I did the research and learned that 95% of all startups will go out of business. The 1 to 5 years is the most risky. You know that, right? I'm not telling you anything you don't know, but here's what you don't know. Here's what you probably don't know. And all your listeners don't know this. When I wrote Exit Rich and did the research, I was flabbergasted because I learned that the business landscape has actually flip-flopped. It has dramatically changed. Now it's only 30% of startups will go out of business, which is good news to Startup Nation. But out of 27.6 million companies, those businesses that have been in business 10 years or longer, 70% of them are at risk of going out of business. 70%. You hear about the big public companies all the time. Toys R Us in business 75 years goes out of business. Kmart, Steinmart, Pier 1. Disney stores going out of business. GNC is closing down 900 locations. Godiva is closing down 1,500 locations. But guess what you're not hearing about? The private businesses on every street corner, in every town, in every state. These business owners are exiting poor. They're selling for pennies on a dollar, closing their business, or even worse, filing for bankruptcy. And the number one reason for that is because business owners stop doing what I call AIM. AIM is AIM, always innovate and market. They stop innovating, they stop marketing. You've seen it. Blockbuster sold Netflix, they did nothing. Toys R Us did nothing in 75 years, nothing different. You're either growing or dying. So product is the second P. And the biggest mistake that business owners make is I've been in business 10, 15, 20, 30 years, and they want to keep doing things the way they've always done them. You can't do that. You have to pivot. You have to innovate. And so I always tell my clients, ask yourself 3 transformational questions. Amazon did this back in the 90s. Ask yourself, what business are you in? Amazon asked themselves, what business are we in? And I said, well, we're in a book fulfillment business. We fulfill book orders. We don't write books. We fulfill book orders. Number 2, what do we do really well, better than everybody else? What's our USP? And Amazon said, we do fulfillment better than everyone else. So then the third question, the most obvious question is, what business should we be in? Should. And Amazon said, we should be in a fulfillment business, fulfilling orders for everybody. Those 3 simple transformational questions transformed Amazon from a small bookseller to a multi-billion-dollar worldwide conglomerate they are today. So the number one reason that businesses fail is in this product category. They don't pivot. They don't add congruent revenue streams. They don't innovate. Make sense?
Yeah. And it's interesting when you think about, the Toys R Us's, these big box retail stores, what they might have had to do to actually weather the storm would cease to be what they have been, right, for 30 years. It would be such a 180 that so many people would have to be laid off. It would be such a different business. And I guess there's probably some good case studies. You would know better than I do about companies that actually pulled that off, but it takes a lot of guts and it's definitely not easy. So for easier.
Well, Walmart did it.
Yeah.
Walmart's done it, and Walmart's done it without laying off a bunch of people.
Right.
Walmart and Target both said during this pandemic, oh my gosh, we got to compete with Amazon. Yeah. Because whoever makes it easiest for the consumer to purchase products and services is the company that's winning. Amazon's winning because you can practically buy anything and have it delivered in 2 days. But Target did it. Walmart did it. They implemented very quickly a membership program. You can go online, order what you want, and they'll deliver to your house same day.
Right.
And the next day.
And on that note, I think we think about big box retail. That's the kind of like obvious example. Are there any less obvious examples of industries that need to innovate now and need to stay ahead of changes?
Well, I would say Godiva is probably one of them since it's closing down 1,500 locations.
Sure.
GNC is closing down 900 locations. They're probably one of them. And I don't, that to me, that's smaller than Toys R Us, especially footprint wise. But yeah, these are all companies that just are not innovating. They're just not, right? They're not innovating.
Right. Yeah. And it's tough to in their situation, but people have pulled it off, just
but Walmart online, people are going and buying things on Walmart online. You're getting stuff shipped to your house. They're competing with Amazon. Walmart did it. Target did it.
Right. Exactly.
The smaller retailers, Toys R Us could have done it. Toys R Us waited too late. So businesses have life cycle, just like humans do. We go from the incubator to death. And adult, is your prime. Amazon should have sold in their prime. In their prime, I think it was 2015, they were worth $11 billion. 2016, they filed bankruptcy. 2017, they closed all 1,500 locations worldwide within 2 years.
Yeah. They really had to stay the course for a while, getting subsidized by investors until now. It seems like it was fated to happen, but maybe it wasn't. We don't know all the other ways it could have played out. So it's an incredible company to watch. Shifting gears a little bit, and if you want to circle back to the last of the 4 Ps now, let me know. Or people can just buy your book, as they should, and get them that way. But one thing that I know you've covered a lot is how to create a bidding war amongst buyers, which is a really juicy topic. So I'd love to learn more about that.
Yeah. So creating a bidding war is number one. You got to operate on all 6 Ps. And the 4th P is proprietary. And so, let me back up a little bit. It's hard to create a bidding war on businesses under $1 million in EBITDA.
Sorry, under what again?
It's hard to create a bidding war on businesses under $1 million in EBITDA. Mm-hmm. EBITDA is earnings before interest, taxes, depreciation, amortization. And the reason why is because there's not as many buyers for businesses under $1 million in EBITDA as there are for buyers over $1 million in EBITDA. Follow me? We have thousands upon thousands upon thousands of private equity groups that buy businesses over $3 million in EBITDA. So there's so much greater competition for businesses over $1 million in EBITDA. So we have a lot more businesses, number one. A lot more buyers, number one. Number two is really identifying those synergies that buyers are willing to pay more money for. And those synergies are in the 4th P, which is proprietary. And there's really 6 pillars of proprietary. But buyers buy synergies. I'll give you an example. We were selling a oil manufacturing business, actually a couple oil manufacturing businesses, but one in particular had a contract with BP. Now, the problem with this business, they operated on 5 of the 6 Ps. They had customer concentration, not customer diversification. 65% of their revenues was tied up in BP. They had a contract. So and they were way over, they were like, over $1 million in EBITDA. They were appraised for $9.8 million. We had 550 buyers. We narrowed it down to 12. We got LOIs, letter of intents, but they all had, a clawback in there if they lose a BP contract or earn out or, different contingencies based upon that contract. But we found a strategic that had similar products and services that had been trying to get in BP for years. They didn't care about the risk. They didn't care about customer concentration. All they cared about was getting their products in there. So they figured, if we buy this company, we have this contract, now we can introduce everything that we have with our other company. They paid $15 million. They outbidded everybody else. They paid $15 million for 70% of the business. That was 126% more than the appraised price, because they wanted that BP contract more than anybody else. So creating a bidding war is more of an art rather than a science. It's, number one, when we have EBITDA over $1 million, then we have a lot more buyers available. We know who the strategics and competitors are, who the pegs are. We know what synergies are most important to different buyers and who's willing to pay more for those synergies. Plus, we also look at who can take advantage of economies of scale, who can cut overhead, by getting rid of maybe some infrastructure that they don't need because they already have the infrastructure, and increase EBITDA. So that's how we create bidding wars.
I love that story. So it's really great because you're helping basically to make a perceived weakness into a strength, which is great. Yeah. And I'm wondering, what advice you'd have for business owners that are getting towards that position. Maybe, like, do you recommend people try to make contact with potential strategic buyers, like networking with these people ahead of time? What are your thoughts there?
Well, you can certainly do that. I always suggest that you reach out to an M&A advisor, because the advisors have the relationships. They know who the players are. especially when it comes to PEGs, because PEGs went and dine us. I mean, PEGs email us, they're calling us, they're beating down our doors on a daily basis because they need deal flow and they can't get deal flow on their own. So I would, PEGs are not going to really beat down your door. They're going to go to M&A advisors. And if you want to maintain confidentiality, which should be every seller's number one priority, you really should work with an M&A advisor and ask them, who do you feel is the best fit for my business, whether it's a PEG, a strategic, a competitor, how do we start this relationship? How do we figure out what synergies they're looking for so I can build my business and meet their specific criteria? Where do my numbers need to be for me to sell for 20 million, 30 million, 50 million, whatever their destination is, their desired sales price, and really work with M&A advisors, because M&A advisors know all that. Well, they should. Let me put it this way. They should. Not all are created equal.
Yeah, makes sense.
Yeah.
We have a few minutes left, so I'd love to just dig into the book a little bit more. And can you tell us, for the listeners, kind of like who is it designed for? Like what stage should you be at to get the most out of this book?
So Exit Rich is really designed for all entrepreneurs, any business owner that owns a business. Exit Rich is not about selling your business. Let's get that crystal clear. Exit Rich is about building a sellable asset, a business that's sustainable, that you can scale, and that is worth something one day that buyers will pay you top dollar for. Because so many business owners get to the end of their journey and they think they're going to sell their business, and then they find out that the business isn't worth anything. And it's certainly not worth what they need to retire on. So Exit Rich is all about building that sustainable, scalable business that is sellable when you're ready for your desired price tag. There's so much content in there about infrastructure before we even get into evaluations and buyers and negotiations and closing. Half of the book is about infrastructure. It's about building those synergies that buyers will pay you top dollar for.
Yeah, that makes sense.
Yeah.
And it seems like that's such it's such a great exercise to build everything around, as opposed to just this sort of like open-ended, I want my business to grow, I want it to do this, that, or the third.
You got to have a goal. You got to have a target. You got to have a destination. I mean, because otherwise you're going nowhere. So Exit Rich is also endorsed by Steve Forbes. Like we said, he said that Exit Rich is a gold mine for entrepreneurs because they leave way too much money on the table when they go to sell their business. Plus Sharon Lechter, who wrote Rich Dad Poor Dad with Robert Kiyosaki. She's a New York Times best-selling author 5 times, plus a CPA, financial literacy expert, and the advisor to many different presidents. She wrote the mentors section after each one of my chapters. And also Kevin Harrington, the original Shark on Shark Tank, wrote the foreword. We got Jack Canfield, lots of great endorsements. Exit Rich comes out June 22nd. You don't have to wait till then. You can go to exitrichbook.com for $24.79, which is less than Amazon. We will email you the digital download immediately so you can start reading it today. Plus, we'll ship the hardcover to your doorstep to anyone that lives in the United States for no additional cost. Plus, we'll give you a lifetime membership into the Exit Rich Book Club. Now, this is only if you buy before June 22nd. And that Exit Rich Book Club has video content and me doing deep dives in different techniques and strategies I've been practicing over the last 20 years with my clients, plus documents to operate your business and sell your business. So we have sample policy and procedure manuals, org charts, employee handbooks, non-compete agreements, sample LOIs, letter of intents, sample purchase agreements, due diligence checklists, closing docs. All the documents you need to operate and sell your business are there for your review and your download. These documents cost you thousands upon thousands of dollars if you went to your attorney to recreate. And they're there for $24.79. Plus, we're giving you a free membership into Club CEOs, which is an entrepreneur mastermind where we do hot seats, Q&As, and really help business owners pivot, also transformational questions so they can build a sustainable, scalable, and sellable business. All for $24.79 at exitrichbook.com.
Awesome. Michelle, thanks so much for coming on. Appreciate it.
Thank you for having me.